members say, we'll give you one more at the next 2 meetings, a quarter point. These 9 members said, we need to cut 1 and 1. This one, and I know that's Austin Goolsby, he's very smart, by the way, he says, we're way behind the curve. We need at least another 50 basis point rate cut because we are behind the curve and I want to avoid a recession. Whether we get 1 or 2, which we will get at least 1, likely get 2. A lot will depend on the next jobs report. In 2025, all of them, even these 2, they've come way down here in how much more we need. It's forecast about 100 to 125 basis points right in this area here of cuts for next year. So what does that do for us? How does that impact us? See, as the Fed funds rate comes down, it has an impact on the 10-year Treasury. The 10-year Treasury will have an influence on mortgage rates. I will piece it all together for you, but let me give you the first mechanics. Anybody here invest in a money market or know somebody who's invested in a money market? You familiar with money market funds? Yes? Yes? Okay. Money market funds follow the Fed funds rate very closely, almost identically. So, when the Fed funds rate was last month at 5 3/4, and then 5.375, and the Fed cut to 4.875, money markets dropped to those levels. So people lost a 0.5%. But what's your alternative? If you said maybe I want to look at a 10-year Treasury, the 10-year Treasury still yielding 4.1. It's good, but you're still getting 4.8 in the money market fund. But if the Fed continues to cut, maybe you start to see in the future, and you say, wait a minute, the Fed maybe cut another 50 basis points, now we're at 4.3. Next year we could be at like roughly 3%. That 4% yield would have been a smart move to take the money and transfer it into that and lock in a yield for 10 years instead of watching it decline, and maybe I only get a better yield for a short period of time. As funds, as smart money managers see the writing on the wall and they take money out of money markets and buy 10-year treasuries, what happens? They buy 10-year treasuries, what happens to the 10-year treasury price? The price goes what? Come on, guys. The price does what? Up. And when the price of a bond goes up, what happens to the yield? The yield goes down. And as the yield on the 10-year treasury goes down, does that affect mortgage rates? Yes. So that's what we want to see. So that's why we pay attention to the building blocks of the Fed funds rate, because it affects everything else. So where can the 10-year Treasury go? So here's a chart showing that last year we hit 3.25%. We bounced around, we moved up, we're a little over 4% now, but it looks to me that a good target would be around 3.25%. So now, that's not where mortgage rates would be, there's a spread above that. You've heard the term spread, right? Yes, yes, okay. So that's what mortgage rates are on a 30-year fix above the 10-year Treasury, which everybody says spread. They don't know what the frig they're talking about, okay? Let me explain it to you. You will know now more than 99% of the industry. I will explain it to you. So, the spread between the 10-year fixed and 30-year mortgages, historically, over a long period of time, look at the green bars, it has been between 1.6 and 2%. Now, there's different times, great financial crisis, COVID, it's bounced out of those zones. So there's unusual circumstances. So, take a look at what happened after COVID. We went way up in the spread, way down, and then we wound up over here in October of 2023, a year ago. The 10-year Treasury was at 5, mortgage rates were at 8.1, we hit this level. Why? The reason is because of servicing. Let me explain it to you. See, nobody holds a mortgage. Who you write your mortgage payment to, who your customers write their mortgage payment to, nobody is holding a mortgage. It is too risky because as interest rates fluctuate, remember, rate goes down, price goes up. Rate goes up, price goes down. So their portfolio would be too risky. So in order to avoid that, they turn it into mortgage-backed securities and they sell it. Who would buy this risky asset? All of you. Each and every one of us, if you look at your insurance plans, your 401ks, your IRAs, your mutual funds, it's loaded with mortgage-backed securities. So it's us that assumes the risk. That's why your returns fluctuate from year to year. Now, you and I, although we own these things, we're not going to collect the payments, we're not going to pay the taxes, we're not going to answer the customer's questions. So we have to hire someone to do that. Who do we hire someone to do these tasks? To answer the customer's questions and collect the payments, pay the bond, all those things. To service the loan. Well, let's hire somebody to service it and call them a servicer. Hence the name servicer. Okay, wonder where that came from. So if you have a servicer that's performing this, are they going to do it out of the goodness or the kindness of their heart? Of course not. You've got to pay that servicer. So how do you know what to pay them? Because you have to establish that value at time of closing. I don't know how long they're going to hold a mortgage. If they're going to hold a mortgage for a long time, we've got to pay them a lot because they're going to service it a long time. If it's going to be a short time, we should only pay them a little because they're going to service it for a short period of time. So we have to best guess the value of that and say if they're going to carry it for this many months, this is the fee that they're going to get. So let me ask you, if you were making that bet and rates were 3%, would you guess that they'd be holding that mortgage for a long time and servicing it for a long time? Yes. So they're going to perform work for a long time, so you got to pay them more, right? Yes? So if you pay them more, that value's got to be built into the price of the mortgage. When you add into the servicing value of the mortgage and that price goes up, what happens to the rate? It goes down. So the spread between mortgage rates and 10-year treasuries does what? Gets narrowed. And you see that right here. When interest rates were 3% or less than 3%, figuring that was going to be on the books for a long time, you paid servicers a shit ton of money, and because you did that, the yield between mortgage-backed securities, or mortgage rates, I should say, on a 30-year mortgage and the 10-year treasury dropped to about 1.4%. But when interest rates went up to 8, what's the chance of that loan refinancing? High, right? They're probably gone right now. So when you have an interest rate at 8, are you going to pay the servicer for a very long period of time or a very short period of time, it's likely? So that's less that you pay the servicing fee, right? Less that goes into the value of the mortgage. If the price goes down, what has to happen to the rate? And that's why the spread went higher, and that's why rates went higher. So you now know more than 99% of the mortgage industry right now. Congratulations. Team, let's think ahead now. So the spread was at 3.1, but today it's at 2.5. Why? Because mortgage rates are not 8% anymore, they're like 6.5%. And while you are still in a position where you could refinance that, it's much less than if it was at 8%. Does everybody understand that? It's not as good as historical levels. It's up here. It's at 2.5. It's not that 1.6 to 2 because this is 3%, this is 4%, this is 5%. Okay, we're not there yet. But as mortgage rates come down, as the 10-year treasury comes down, as the Fed comes down, what will happen to the spread, everybody? What will happen to the spread? It will narrow. So now this gives us the basis of how to look at where mortgage rates are. But I've got to take you on that journey, because otherwise everybody else pulls this shit out of their ass. And what we're trying to do is give you a foundational logic reason. Could it be wrong? Of course. But it is not a guess without merit. So, where can mortgage rates go in the next 6 months? We just thought that the 10-year treasury could hit 3.25. Very important. Now, let me ask you on the spread. You know the current spread's 2.5, but you know as rates come down, that spread will shrink. Okay, maybe it won't get in that range of 1.6 to 2 because we're not going to get that low. But what would you guess, everybody? Give me a number. You like 2.25? I'll go with 2.25. I like it too. So let's add 2.25 to it. So where are we? Next 6 months or so. It's reasonable to assume that rates go to 5.5. So now I ask you, are you planning your business this way? Is this what you're looking for? Are you sheltering money, sheltering marketing, sheltering resources, letting people go? Or are you saying, wow, I want to be there to capture this type of business? I'm digging in right now because I know things are going to get better. Are you thinking of getting out of the business? It'd be a big mistake because rates are going to get a lot better. And this is what we have to understand, but this is why. Now, let's take a look at history, because some of you say, well, okay, Barry, the Fed cut rates, but we saw rates go up. Yes, the employment report had something to do with it too, but it is not unusual. Let me show you 40 years of history when we start an interest rate cutting cycle. What does that mean? When the Fed has been hiking rates and then they stop, they pause, and then they start cutting, that's the initiation of a cutting cycle. In the last 40 years, they've done it 10 times. So, here's the amount of the cut. Here's September 18th. You can all see at the bottom line. The 10-year treasury was 370. Now, we've seen a spike in that of 36 basis points, but it's not unlike what we've seen in the past. 9 out of 10 times they've spiked. Why? A lot of it was built in before the cut. It's a classic buy the rumor, sell the news. But also a lot of the money goes into the stock market. If you see the stock market rally, the Fed starts cutting, stock market initially rallies, and then that money goes from bonds into stocks, and that's what fuels the stock market rally further, because they want to chase higher returns. This is where rates went to the peak after the cut. And this is what happened later on. Because later on, after they hit this initial short-term peak, rates come down. And you can see how much they came down to. Now, clearly, we don't know what the low will be here, but this is the amount in interest rate, what they came down to. This is the percentage change. So if we took the percentage change, because that's more relevant, and averaged it, we can see that on average, yields on the 10-year Treasury hit a low that's 37% lower than where they were when the Fed initiated the rate cut for the first time.